We go on now and we look at August. A payment of 900 was received from J. Barry, a debtor whose debt had been previously written off. So he's not in the accounts at all. This represents 60% of the original debt, and Barry has undertaken to pay the remainder of the debt. So look, we got in the 900, so we debit the bank 900, and we credit bad debt recovered 900. That's a gain. And then he said he wants to pay us the balance, so we need to find out what the original debt was. So 60% equated to 900. Therefore, 100% equated to 900 divided by 60 multiplied by 100, which gave us 1,500 euros. So the original debtor was 1,500. He paid 900, so there's 600 due. So therefore, we increase the debtors by 600, and we increase the gain in the profit and loss account by another 600. On the same adjustment then, on the same day, goods to the value of €369 were sold on credit to Barry. This includes VAT at 23% and a markup of costs of 20%. So we go down and we look at down here, and we see down at the end, there's the 369 divided by 1.23, which gives me 300. So that's the retail price without the VAT. So the VAT is the difference between the 369 and the 300. We divide it by 1.2, and that gives us 250. That's the figure we have in stock. So the adjustment is credit the sale in the trading account at 300, credit VAT in the balance sheet 69, we owe it, and debit the debtor. He owes us €369. We're reducing the stock in the balance sheet, therefore we reduce the stock in the trading account. Now we have to put that in to the adjustment. Note that we're going to net off the sales in the trading account and the stock in the trading account, so there will be a gain there of €50, as you'll see in the P&L gain. Now let's have a look at this now. This was not that easy as well. You can see the stock being reduced, and you can see the debtors going up by 600, which was how much he owed from the start, plus the 369. The gain to 1,500 and the gain of 50. And then, of course, the 900 going into the bank and the €69 that we owe the VAT. Now, the last adjustment that we have to do then before we take another break would be in September. And let's have a look at how the September thing. The bank received 50,000 from the issue of the remaining shares. And this is not as easy as you think. The ordinary share capital at the start of the year was 560,000. And then we issued new shares of 200,000, bringing the issued share capital up to 760,000. The authorised was 800,000, so therefore there was 40,000 remaining. So we got into 50,000, 40,000 went to the share capital, and the balance, that's the 10,000, went to the share premium. So, and this is how it would appear in your tab statement. Look at September there, you have your ordinary share capital, 40,000, your share premium 10,000, and your bank overdraft being reduced by 50,000.